Okay, the other source of finance that we should look at is venture capital. Now, what is venture capital? Remember, we're looking at long-term sources. We have just concluded on equity. Now we're going to venture capital. So, what is venture capital? Venture capital is risk capital provided in return for equity stake. Okay, so what happens is we have people known as venture capitalists. They have money, but they're not good at businesses. Now, if they see someone who is very good at business but doesn't have enough capital, they are willing to invest money in such businesses. But once they invest money in such business, they are willing to take a shareholder's role. So they'll say, I'll provide money in your business, but I should also become a shareholder. And you're going to make agreements in terms of how you share profits. But these venture capitalists can exit at any time. If they see that they have achieved their purpose, they might exit. Now, what are types of ventures? So ventures, there are into four types. We have business startups. So when you have new businesses which are just starting up. Then business development, you're trying to develop your business. Management buyout. So management buyout is when managers within the company decide to buy a company. So for example, if you have a company like JNM, managers of JNM can decide to buy JNM. That's management buyout. Then the owners want to realize his assets or entire business. So as an owner, maybe you want to sell your assets that you have. You can use a venture capitalist to help you in such adventure. Venture capital funds. So what are venture capital funds? So venture capital funds are a special type of fund giving investors tax relief. So people who are interested in venture capital finance will be provided with tax relief. In simple terms, they'll save tax on loans or maybe on subsidies or on interest. On top of that, in venture capital funds, they are going to reward themselves, these investors. So they reward themselves by taking a percentage of portfolio of funds investment. So what it means, these venture capitalists in that business which they have invested in, they will take a certain percentage of what they have invested. Okay. So it's like the pension funds, alright? So these are also funds. So a venture capital, any person who is interested in venture capital will also have to deposit the money within the venture capital fund. So those venture capital funds will take a percentage from what this person has invested. So how can you find the venture capital? It's not easy to find them. So the best way you can find the venture capital is by the institutions. So we're going to the institution, we want an equity stake in the company. So those institutions like banks, they might be interested maybe to have a shareholding in your business. So your business, you have a small restaurant. So the banks can invest in and they would like to also be the owners. Then when you're trying to find the venture capital fund, you should be able to convince the company that will be successful. So convince these investors that the company you're investing in will be successful. And also, you as a venture capitalist, the one who is very busy, that has money, you need to appoint a representative. Because if you don't appoint a representative, something bad might happen. Now, why is venture capital different from other sources of finance? How is it different? So it is distinct from other sources of finance because, one, in terms of ownership, venture capital usually takes 20 to 49.9% of the shares. So you as a venture capital, you have money, your holding will be even more than 50%, will be maybe more than 50%, while some shareholders can have only 10%. Next, in terms of law, so venture capitalists, what they'll do, or venture capital will go for advisory and they'll have an influence, but does not run the business. Even though they have got an influence, they are not there to run the business. They've just injected capital into the business. In terms of return, Return takes a long period of time. It may take even 3 to 5 years, provided there's a sound agreement. Then exit. These people, I told you that they can exit at any time. When their objective has been achieved, they will leave the business and take their money with them. So the venture capital can plan to sell the investment later, often by trade sale or stock market listing. So that's venture capital. Any question?
No question.
Business angels. Business angels and venture capital are the same. Only that the business angels, they don't exit anyhow. They can still be there for a long period of time. But and venture capital are almost the same. So still more, just as venture capitalists, business angels are wealthy individuals investing personal funds in startup businesses. So these are very wealthy individuals. So what they will do, they will provide the foreign services. They will provide mentoring and networks. So they will give you the networks of how you can improve your business. And they also provide management expertise. Well, remember, venture capitalists will say they are busy individuals, they will just invest money, but these will provide their management expertise. And business angels are suitable for SMEs with limited access to capital markets. So small, medium-sized entities that don't have access to capital markets might go for business angels. Now, another source of finance is debt finance, where we're going to spend most of our time. So debt finance, in simple terms, is using debt to run your business. So there are various types of debt finance that we're going to look at. We'll look at bonds, we'll look at debentures, mostly. Then we'll look at also other types as we go back. And we're also going to break the bonds into various parts. But for now, let's appreciate what bonds and debentures are. So a bond, a simple definition of a bond, we say is a loan which has a written acknowledgement. That's a bond. So a loan which has got written instructions and it can be sold. So it's like a loan but it has got a market price. So a bond is a long-term debt capital raised by a company for which interest is paid, usually half yearly and at a fixed rate. But a simple definition I said is a bond with a written acknowledgement. So you also be paying interest just as a loan. Advantage of a bond, there will be immediate finance with low cost. So you get funds as quick as possible. And also the costs are limited to interest payments. So you'll not be paying this money at once, paying that at once, you'll just be paying the interest payments. Its advantage is that whether you like it or not, you have to pay interest. And also it might increase your gearing. Therefore, this causes risks to shareholders. Then we have a debenture. The simple definition of a debenture, we say is a loan which is payable on demand. It's a loan which you get from people sometimes, such as in Malawi and Caterpillar. So it's payable in demand. But in other countries it's cheap. In Malawi it's expensive. So debenture is a form of loan note, the written acknowledgement of a debt incurred by a company, normally containing provisions after the payment of the interest and the eventual payment of capital. So this debenture will tell you the details of how much interest you're going to pay and when you're going to repay the capital. Advantage, it is cheap. But in Malawi it's expensive, take note. Cost limited to interest payments. So the cost that you're going to suffer is only the interest payments that you have agreed. Its advantage, you have to pay interest. Furthermore, it will pose high risks to shareholders because of the gearing, debt finance. Now we said the most common type of a debenture or debt is a bond. So let's now appreciate the bonds in detail. Types of bonds. So we appreciate 4 types of bonds. We have deep discount bond, zero coupon bonds, convertible bonds, some people call them as hybrids, and hybrids with warrants. So let's move on. What are deep discount bonds? So deep discount bonds are bonds which a large value of discount is provided. Okay, so a bond where you provide a discount in simple terms. That's a simple definition. So in simple terms, we can say loan notes issued at a price which is at a large discount to the nominal value of the notes, and which are redeemable at par when they eventually mature. So you can have a bond at 100,000 kwacha. It has interest, but the owner can tell you that at the end of the period, just pay back 100,000. There will be a deep discount where I will not charge you maybe any interest. So that's a deep discount bond. So, or sometimes you can pay less interest. Then we have got a zero coupon bond. A zero coupon bond is whereby no interest will be paid at all. In a deep discount bond, you can pay a little interest, but in a zero coupon bond, you will not pay any interest. Coupon actually means interest. So these are bonds that are issued at a discount to the redemption value, but no interest is paid on them. So you give a discount, on top of that, no interest is paid. Then we have convertible bonds or hybrids. Convertible bonds are bonds which can be converted to equity. So you get a loan, then later on you convert it to equity. You have the option of changing it into shares. So we are saying convertible bonds are bonds that give the holder the right to convert their securities, normal ordinary shares, at a predetermined price and time. So you can change them to shares. Then we have hybrids or warrants. So hybrid with warrants are the same as the convertible bonds, but here you are given the right. You always have the right to convert these bonds to ordinary shares. So you'll be told that after 5 years maybe we are going to give you 500,000 shares instead of the loan. That's hybrid with warrants. So it gives the holder the right to subscribe at a future date for a certain number of ordinary shares at a predetermined price. Now, in debt finance, we might have covenants. Every loan has got an agreement known as a covenant. So a loan covenant is undertaken by the borrower, or agreements which you as the borrower must satisfy. So a loan covenant might have the following features. One, you have to provide information. So you as the borrower, you must give the lender regular financial reports. So how much money you are making, or when you are going to pay. If you are in challenges, explain to the financial institution. Then also you need to have a negative breach. So what we mean here is that as the borrower, you must not give other lenders better security over its assets. Okay, so you must not give other lenders better security over its assets. What it means, if you get a loan from someone of 20 million, there's no way you have provided your car as a security, then you're going to borrow money to another person, you give the same security. That's not accepted. Then financial confidence. Here in financial confidence, as the borrower, make sure you stay within agreed financial limits, such as gearing or interest cover. So you agree to say, if you're going to get a loan from me, your gearing should not exceed 50%, and your interest cover should not be less than 3 times. Then we have restrictions. So you as a borrower will be limited to actions like taking more debt, example, paying dividends, or making large investments. So that's